Have you been watching the precious metals market lately? If so, you've probably noticed something pretty interesting. It's not about massive price swings, but more about a strange imbalance. Silver has been hanging out near some historically high levels, while gold just keeps climbing, slow and steady. A lot of people are looking at this and thinking, here we go, silver's about to have another huge breakout. But hold on a second. In markets where we compare one asset to another, this kind of divergence, this pulling apart, is often the real story. Let's take a closer look. Recently, silver was trading in the low 90s per ounce, but at the same time, gold was on a more consistent upward path. This brought the gold to silver ratio down, compressing it toward the low 50s. Now, a ratio in the low 50s isn't completely unheard of, but history tells us that these levels don't usually stick around for long. They tend to be unstable unless there's a major, lasting shift in the actual physical demand for silver. When the ratio started to widen again, it was a signal that things might be returning to a more familiar pattern. So, what is this gold to silver ratio, and why is it so important? Well, it's more than just a simple price comparison. It is a powerful indicator of how the market is feeling about two very different things: monetary risk and industrial growth. Think of it like a seesaw. Over long periods, the ratio tends to widen, meaning gold gets more expensive relative to silver during times of economic stress or when industrial activity is weak. Why? Because in those times, investors flock to gold as a safe haven. On the other hand, the ratio compresses, meaning silver gets more expensive relative to gold when there's strong demand specifically for silver in industrial applications. This brings us to a crucial point. When silver starts outperforming gold without any real change in the underlying fundamentals, that imbalance usually corrects itself. It's like a rubber band being stretched too far. Eventually, it has to snap back. Historically, silver has very rarely been the leader in precious metal cycles. It's more like gold's hyperactive sidekick. Silver typically amplifies whatever gold is doing. Let's break that down. When gold prices rise because of big picture macroeconomic factors or monetary policy changes like inflation fears or interest rate cuts, silver tends to follow, but with a lot more volatility. It shoots up faster and higher. But here's the flip side. When financial conditions tighten and the market pulls back, silver often takes a bigger hit, absorbing more of the downside than gold does. This lopsided behavior, this asymmetry, all comes down to silver's unique dual identity. It's both a monetary metal, like gold, but it's also a critical industrial commodity. Gold's value is primarily driven by its monetary role. It's the ultimate store of value, a hedge against currency devaluation and global uncertainty. Its industrial use is relatively minor, mostly in jewelry and some high-end electronics. This makes gold's price movements a cleaner reflection of investor sentiment about the global economy and financial stability. When people are worried, they buy gold. It's that simple. Silver, however, is a different beast altogether. Over half of all the silver mined each year is consumed by industry. It's essential for everything from solar panels and electric vehicles to smartphones and medical devices. This industrial demand creates a completely different dynamic. When the global economy is booming and manufacturing is strong, the demand for silver rises, pushing its price up. But when the economy slows down, so does industrial production, and that puts downward pressure on silver prices. So silver is constantly being pulled in two directions: by investors who see it as poor man's gold, and by manufacturers who need it for their products. This dual nature explains why the gold to silver ratio is such a fascinating barometer. When the ratio is high, it's telling us that the market is more concerned with preserving wealth and hedging against risk. The monetary function is dominant. When the ratio is low, it suggests the market is optimistic about economic growth and industrial expansion. The industrial function is in the driver's seat. So when we see silver's price surge ahead of gold's, we have to ask ourselves, is this because of a sudden, massive increase in industrial demand? Is there a new technology that's gobbling up all the silver? Or is it simply speculative fervor with traders jumping on the volatility bandwagon, hoping for a quick profit? More often than not, it's the latter. Speculators love silver for its wild swings, but these speculative rallies often lack the fundamental support to be sustainable. Think about the recent market movements. While there is growing demand for silver and green technologies like solar and EVs, has it been enough to justify its price outrunning gold's so significantly? The evidence suggests maybe not. The move seemed to be driven more by market sentiment and speculative positioning rather than a seismic shift in physical demand. And that's why we're seeing the ratio start to correct. The market is reevaluating, and the historical relationship between the two metals is beginning to reassert itself. It's important to remember that gold and silver, while both precious metals, play very different roles in a portfolio and in the global economy. Gold is your defensive player, your reliable goalkeeper protecting your wealth during turbulent times. Silver is your star striker, capable of scoring spectacular goals, but also more prone to getting caught offside. It offers higher potential returns, but comes with significantly higher risk. So, what does this mean for you as an investor or someone just interested in the markets? It means context is everything. Don't just look at the price of silver in isolation. Always compare it to gold. The gold to silver ratio provides a valuable layer of insight that can help you understand the deeper forces at play. Is the market feeling fearful or greedy? Is the economy expanding or contracting? The ratio can give you clues. A widening ratio might signal a risk-off environment, where it might be prudent to favor the stability of gold. A compressing ratio could indicate economic strength and a risk-on appetite, where the higher growth potential of silver might be more attractive. But be wary of extreme compressions that aren't backed by fundamentals. Those are often the moments when the market is getting ahead of itself, and a correction could be just around the corner. Ultimately, understanding the intricate dance between gold and silver is key to navigating the precious metals market. It's a story of monetary stability versus industrial growth, of fear versus optimism, and of long-term value versus short-term speculation. The recent divergence wasn't necessarily a sign that silver was about to leave gold in the dust. Instead, it was a classic example of a market imbalance, a temporary deviation from a long-established relationship. As the ratio begins to normalize, it serves as a powerful reminder. In the world of precious metals, gold is still the king, and silver, for all its flash and volatility, usually follows its lead. Thanks for watching. If you found this breakdown of the gold and silver markets helpful, be sure to hit that like button and subscribe to the channel for more deep dives into the world of finance and investing. Let me know your thoughts on the gold to silver ratio in the comments below. See you in the next video. For years, if you listened to anyone bullish on silver, you'd hear one key phrase over and over: solar energy. The story was simple and powerful. As the world embraced green energy, the demand for solar panels would explode. And since silver is a critical component in photovoltaics, its price was destined to go to the moon. This narrative wasn't just speculation, it was backed by real data. For the last 10 years, solar panel manufacturing has been the single fastest growing driver of silver consumption. It built what many believed was a permanent structural floor under silver prices, a guarantee that demand would always be there, always be growing. But what if that foundation is starting to show cracks? What if the story we've all been told is changing right before our eyes? Today, we're going to dive deep into the numbers and uncover the hidden truth about silver as relationship with the solar industry. The reality is far more complex than the simple more solar equals higher silver prices narrative. The ground is shifting, and if you're invested in silver or thinking about it, this is a conversation you absolutely need to hear. Let's start with the big picture: global solar deployment. For a long time, it felt like the growth was limitless, expanding at an exponential rate year after year. We saw massive solar farms pop up across deserts and rooftops covered in panels. This rapid expansion was the engine pulling silver demand along with it. However, that explosive growth phase is starting to mature. Think of it like a startup that goes from 0 to $1 billion in revenue. That initial hypergrowth can't last forever. Eventually, it settles into a more stable, linear growth pattern. That's what we're seeing in the solar market today. We're running into some very real-world limitations. First, there are grid constraints. You can generate all the solar power in the world, but if the existing electrical grid can't handle it, you can't use it. Upgrading national grids is a colossal, expensive, and time-consuming task. In many regions, the grid is already struggling to integrate the renewable energy that's currently being produced, creating a bottleneck for new projects. Then there's the issue of permitting and land use. Getting approval to build a large-scale solar farm can take years. It involves environmental impact studies, community consultations, and navigating a maze of bureaucracy. As more land gets developed, finding suitable, uncontroversial locations becomes increasingly difficult. We're simply running out of the easy spots. Finally, we have market saturation. In certain key markets, especially across parts of Asia that were early and aggressive adopters of solar, the pace of new installations is naturally slowing down. They've already achieved a high level of solar penetration, so the marginal growth from here on out is going to be smaller. It's not that solar is stopping, it's that the rate of acceleration is decreasing. The S-curve of technology adoption is beginning to flatten at the top. So, the first pillar of the old silver story, endless exponential growth in solar installations, is becoming less certain. Now, let's talk about the second, and arguably more important, part of this equation, the technology inside the solar panels themselves. This is where things get really interesting. When a commodity like silver becomes expensive, it creates a powerful incentive for innovation. Manufacturers don't just sit back and accept high costs, they actively work to reduce their reliance on that expensive material. And that is precisely what has been happening in the solar industry. For the past decade, engineers and scientists have been on a relentless quest to use less silver in each solar panel without sacrificing efficiency. This process is called thrifting, and they've been remarkably successful. They've achieved this through several key innovations. First, they've improved the design of the panels. The silver lines on the surface of a solar cell, which collect the electrons, have become thinner and more efficient. Think of it like printing a circuit board with finer and finer wires. Second, they've developed better deposition techniques. The methods used to apply the silver paste onto the silicon wafer are now more precise than ever, minimizing waste and ensuring that every tiny particle of silver is used effectively. It's a game of micrometers, and every fraction of a gram saved adds up to tons of silver across millions of panels. And third, they're exploring and implementing alternative materials. Copper, for example, is a much cheaper and more abundant conductor than silver. While it has its own technical challenges, researchers are making significant strides in using copper-based pastes or hybrid plating techniques to replace some or even all of the silver in certain types of solar cells. Every time a breakthrough like this occurs, the long-term demand for silver takes another hit. The combined effect of all this innovation is profound. The amount of silver required to produce 1 gigawatt of solar energy is falling, and it's falling fast. Let me repeat that because it's the core of the issue. Even if the total number of solar panels being installed worldwide continues to grow, the total amount of silver consumed by the industry might not. It could flatten out or even start to decline. This creates a completely new demand profile for silver. The automatic link between solar growth and silver demand has been severed. We can no longer just look at charts of projected solar installations and assume silver consumption will follow suit. The efficiency gains are creating a powerful headwind. And we're already seeing the effects of this in the real world. If you look at the behavior of institutional buyers and industrial consumers, their purchasing patterns have changed. A few years ago, when the solar boom was in full swing, there was a sense of urgency. Manufacturers were stockpiling silver, trying to lock in supplies before prices inevitably went higher. Today, that urgency has faded. They are showing much less appetite to secure large volumes of metal, especially when prices are elevated. They know that technology is on their side, and their future silver needs per panel are likely to be lower than their current needs. This introduces a critical asymmetry into the market. When silver prices spike, it pours fuel on the fire of innovation. Manufacturers double down on their efforts to thrift and substitute, reducing their consumption. But here's the key. Once those new, more efficient manufacturing processes are in place, they don't go away. Even if the price of silver falls back down, factories don't just switch back to the old, less efficient, more silver-intensive methods. The technological gains are permanent. So a high price for silver actively destroys future demand, and a lower price doesn't necessarily bring that demand back. This is a huge problem for the long-term bullish case. It means that every price spike makes the industrial demand base a little bit weaker and a little bit smaller over the long run. Now, let's consider the supply side of the equation. In a typical commodity market, if demand starts to weaken, you might expect producers to cut back on supply to rebalance the market and support prices. But the silver market doesn't really work that way. A significant portion of the world's silver isn't produced from primary silver mines. It's actually a byproduct of mining for other metals, like lead, zinc, and copper. This means that the supply of silver is often inelastic. The decision to open, close, or scale back a mine is usually driven by the price of the primary metal, not silver. A copper mine isn't going to shut down just because silver prices are a bit weak. It will keep producing copper, and the byproduct silver will keep flowing into the market regardless. This lack of a supply-side response means that any imbalance caused by weakening industrial demand has to be resolved almost entirely on the demand side. There's no major production cut coming to save the day. So, what does this all mean for the future of silver? It means we need to be much more critical of the simple, bullish narratives. The idea that silver is a one-way bet on the green energy transition is outdated. The relationship is far more nuanced. Industrial demand, particularly from solar, is no longer the guaranteed growth engine it once was. The combination of slowing installation growth, rapid technological innovation, and an inelastic supply creates a very different picture for the coming years. This doesn't mean silver is destined to crash. It still has a role as a precious metal and a store of value, and there are other sources of industrial demand. But the single biggest pillar of the modern bull case has been fundamentally weakened. The market is adapting, and investors need to adapt as well. The story has changed. Relying on the old playbook could be a very costly mistake. We have to look at the data, understand the technology, and appreciate the complex dynamics at play. The future of silver will be written not just by global energy policy, but by the quiet, relentless work of engineers and labs, constantly finding new ways to do more with less. Thanks for watching. If you found this analysis helpful, make sure to like this video and subscribe to the channel for more deep dives into the markets. Let me know your thoughts on silver's future in the comments below. See you next time. Hey everyone, and welcome back to the channel. Today, we're retackling a question that's been flooding my comments section. Why is silver struggling to catch up to gold? We've seen gold make impressive new all-time highs, yet silver seems stuck, moving in fits and starts, often amplifying the downside movements. If you've been feeling frustrated by silver's performance lately, you're not alone, but it's crucial to understand why this is happening. It's not a conspiracy, it's a fundamental market rebalancing based on structure, liquidity, and shifting macroeconomic priorities. We're going to break down 5 key reasons silver is lagging, focusing on structural market dynamics rather than just daily price action. We'll look at the role of volatility, the hidden impact of margin requirements, the confusing signals from inventory data, the massive macro shift toward monetary assets, and finally, what the critical gold to silver ratio is telling us right now. Understanding these points will give you a much clearer perspective on where silver is headed in the medium to long term. Let's start with market structure and liquidity. This is the foundation. Silver's market is significantly smaller and shallower than gold's. Gold is the third most traded commodity in the world, with deep institutional involvement, massive sovereign reserves, and constant 24/7 trading that can absorb huge capital flows without major disruption. Silver, while still important, has much thinner liquidity. This thinness creates a fascinating and often frustrating dynamic. During massive rallies, silver's volatility is a huge benefit. It attracts leveraged traders who can amplify the upside faster than gold. This is why, when things run, silver often outperforms. But that same thin liquidity is a double-edged sword. When momentum stalls, or when the broader market pulls back, that thin liquidity amplifies the decline just as dramatically. Think of it like navigating a small boat versus a massive oil tanker. The small boat, silver, can change direction quickly and accelerate rapidly, but it's also far more vulnerable to waves and headwinds. And the tanker, gold, is slow to turn but incredibly stable through rough seas. This brings us directly to our second point, the silent killer of silver momentum, which is rising volatility and its effect on margin requirements. When silver starts running hot, volatility naturally increases. Exchanges, like COMEX, don't ignore this. To maintain stability and prevent systemic risk, they quietly raise the margin required to hold a futures contract. When margin requirements go up, speculators, the people using borrowed money to amplify their bets, are quietly forced to shrink their positions. They have to either put up more cash or sell contracts. The selling pressure, even if minor, acts as a continuous headwind, draining the upward momentum right out of the market. This structural friction means that even during positive news cycles, it's hard for silver to maintain that turbocharged momentum because the cost of leveraging those positions keeps rising. Gold, being less volatile and deeper, doesn't face the same constant pressure to liquidate leveraged positions. The third point is about inventory signals, which are often misinterpreted in the news. You'll frequently see headlines saying silver inventory is declining at exchange X, scarcity imminent. But we need to look beyond the headline and analyze the complete picture. Declines in inventory at one exchange or in one specific region do not automatically signal global scarcity. Inventory may be rising at other exchanges, or perhaps the overall industrial consumption in key areas is slowing down, reducing demand for those specific registered stocks. Furthermore, we often see a phenomenon where retail tightness can coexist perfectly fine with broader surplus conditions. Retail investors buying small bars and coins can totally wipe out local dealer inventories, leading to delivery delays and high premiums. This feels like a severe shortage to the retail buyer. However, at the institutional level, the amount of silver available for industrial use or large-scale physical delivery might still be ample, meaning the spot price isn't reflecting that local retail panic. We have to be careful about extrapolating local inventory issues into a global crisis narrative. Until we see comprehensive, sustained drawdowns across all major exchanges, New York, London, and specialized regional hubs, the market isn't going to price in a true scarcity premium. Now let's move to the most powerful force dictating this divergence, macro capital flows. This is point number 4. We live in a time of persistent economic uncertainty, geopolitical risk, and major transitions in monetary policy. When capital managers feel threatened, where do they go first? They flow into assets that offer the clearest, most established, and most liquid monetary hedge. Gold fits this function perfectly. It has 5,000 years of history as the ultimate monetary asset. Central banks hold it. Governments recognize it as a core reserve asset. When institutional capital needs to move hundreds of millions or even billions of dollars into a safe, non-sovereign store of value quickly and without disrupting the price, they use gold. Gold's deep liquidity allows these massive reallocations to happen relatively seamlessly. Silver, on the other hand, is split. It's part industrial commodity, used in solar panels, electronics, and medical devices, and part monetary metal. Right now, with industrial growth expectations still somewhat sluggish globally, capital views silver primarily through the lens of industrial cyclicality. As macro uncertainty rises, capital is prioritizing the monetary hedge function, gold, over the industrial growth potential, silver. This means gold gets the bulk of the initial capital inflow, reinforcing its relative strength during these transitional phases. Investors are choosing pure protection over the hybrid risk-reward profile of silver. And this leads us perfectly to the fifth and arguably most telling factor, the gold-to-silver ratio. This ratio tells us exactly how investors are weighing growth, risk, and monetary protection in real time. The ratio is simply the price of gold divided by the price of silver. A high ratio means silver is historically cheap relative to gold, and a low ratio means silver is relatively expensive. Historically, the long-term average is somewhere around 55:1 or 60:1. When the ratio spikes to 81, 91, or even higher, it means the market is overwhelmingly concerned with uncertainty and prioritizing gold's monetary role. Right now, the ratio has been sticky at an elevated level. This isn't just a number, it's a reflection of how risk-averse the world's biggest capital pools are. When the ratio is high, it screams, we expect slowing growth and we are focusing on capital preservation. Here's the key insight about the ratio. Once relative trends are established, they tend to persist longer than expected. If the ratio starts rising because of macro uncertainty, it usually stays high until a clear signal emerges that either the uncertainty has passed or industrial demand is about to explode. We are currently in a rebalancing phase defined by this high ratio, where capital is methodically rotating into the purest form of money. So, when does silver regain leadership? Silver is not failing, it's just being repriced relative to gold based on these structural and macroeconomic factors. For silver to truly break out and resume its high beta leadership role, we need definitive positive signals on two main fronts. First, we need clear evidence of accelerating global industrial growth. This means the infrastructure spending everyone talks about has to actually materialize and push demand forecasts higher, or substitution technologies that use less silver need to slow down their adoption curve. Second, we need a clear reduction in systemic macro uncertainty. When the market is confident that a new cycle of growth is starting, capital will happily move out of gold's pure safe haven status and back into silver, embracing its higher leverage to a cyclical upswing. Until those signals appear, until the growth acceleration is undeniable and the capital flows shift away from pure monetary protection, the market will likely remain in this rebalancing mode. The resolution for silver won't come from a single flashy headline, but from the steady interaction of these forces over the coming months. It's a process, not an event. The key takeaway here is patience and perspective. Understanding the mechanics of liquidity, margin, and macro flows helps us avoid panic and recognize that silver OES path is dictated by different structural demands than gold OES. Keep watching that gold to silver ratio. When it decisively and aggressively breaks down, moving towards the 70s and 60s, that is when we'll know the market structure has shifted and silver is truly ready to fly again. Thanks for tuning in. Let me know in the comments if you agree with this market structure analysis and what factors you think will drive silver's next big move. Don't forget to like and subscribe for more deep dives into the precious metals market.